Okay, so let's talk about some terminology. Before we carry on and push on, let's just run through all this so we're all up to speed and understand exactly what each of these things mean. We'll go into a little bit more depth with some of them, others we won't. So long is basically buying a stock or an index. It's a bullish trade. When you're buying or going long, you're effectively saying, I expect this share, this stock, this index, or this currency pair to go higher, and I want to profit from a move, a higher move in this. So if you're buying a share at 100 pence and it goes to 110 pence, you want to make a profit. So it's a bullish trade. And then vice versa, you've got going short. And shorting is basically selling a stock or an index or whatever the asset may be, expecting the price to go lower. So you're looking to profit from a fall in that value, with the value of that asset. And that is a bearish trade. And we'll go into a little bit more depth about that, about shorting in a second. So we'll talk about stake. Now stake is how many contracts that you want to trade on that CFD. So you could have, it could be completely whatever you want to do. You want to trade one CFD, you want to trade a million CFDs, absolutely fine. Of course, you've got to have the funds to cover this. The broker's got to be able to agree to this, but it's just ultimately multiplying the valuation of what you're buying. Exactly if you were buying a share. And if you're buying 10 shares of something, you're buying 1,000 shares or something, it's affecting the value of the position that you have. Now a tick is the minimum increment of movement on the underlying asset. So for example, if you look at something like Tesco, that will be priced at a low range and it will move in quarter penny ticks. If you look at something like Facebook or Apple, that will move in 1 cent increments. That's the minimum amount that it will move. If you look at the FTSE may be a value of a tick may be half a point in the FTSE, or it may be 0.1 depending on how some brokers package it differently. The same with currencies. Some might be 1,000th of a point, a penny. Some might be 1/10, some might be a whole penny. So you've got to look and see what the instrument you're trading to see kind of what the minimum increment of movement is before the price changes. So as price goes up, it moves up 1 tick. It's the minimum amount that you can move if you're going to make a move. Underlying, so this is the asset which your CFD is based on. Now obviously if you're buying a Facebook CFD, that is based on the stock, Facebook stock, Apple, Amazon, eBay, whatever it may be. Same with the UK shares or German shares, whatever. That's fairly obvious, and there's an obvious symmetry there between the underlying asset and your CFD. Now if you're trading a basket of stocks, like the FTSE 100, that is going to be based on obviously the FTSE 100. Now they may well adjust it for a cash valuation or for a futures valuation. It may not be based on specifically the index, but ultimately the underlying just is what is actually the valuation of the CFD is built around. So while it may not track it identically, and it may be adjusted very, very slightly here and there for different costs and everything, ultimately the shape of the chart, which is all we really care about as traders, if the thing goes up, we want to make money. If the thing goes down, we're going short, we want to make money. The shape of the chart is ultimately going to be identical. So the underlying is the asset. It could be gold, it could be crude oil, it could be FTSE 100, Dow Jones, Nasdaq, whatever it may be. The underlying is basically what the CFD is based on. It's at the core of the contract, if you like. The contract's based around that, and all the different parameters, the size, the stake, and all this kind of thing are all based around the underlying asset that it's built on. And that's how the CFD will be valued. Now, when we talk about the quote, we're talking about the buy and sell prices for a specific instrument. So it's going to be, you can't buy and sell at the same price. You have a bid and you have an offer price in the exchange. So let's get out the drawing pen and make a little brief example. If you know this already, then that's fine, but you may have something like this. So you've got the bid, and this is in the exchange. Let's say the bid here is 98.0, and the offer, or ask actually as they say in the US, but we tend to call it the offer in the UK, may well be 98.5. And that often, not always, but often, that difference is 1 tick. In other words, it's the minimum increment you can get. Sometimes it's wider than that depending on the liquidity of the instrument that you're looking at, but generally speaking, in a reasonable environment with reasonable volume under normal conditions, most high volume things are going to be that kind of thing, maybe one or two ticks. 2 ticks wide. So what does that actually mean for us? It means that basically if we want to buy a CFD, we're going to have to pay this price here, 98.5, because that is the price that's available to us if we are buying right now, 98.5. If we want to sell a CFD, this is the price that we're going to get for our CFD if we sell it, which is 98. So the difference in that is called the spread. Look at that in a second. But ultimately, that's your quote. It's the buy and sell. So they're basically saying if you want to sell it, you get 98. If you want to buy it, it'll cost you 98.5. Pretty simple. Okay, let's talk about mark to market. Now, mark to market is basically what your open trades are referenced against. We're going to go into this a little bit more depth when we talk about margin and gearing and leverage and stuff, but briefly let's just understand it now. It's how trades are referenced against. So at the end of the day, at a time-stamped point, your current trade has a valuation between what it was last night and what it is now, based on the size of the position and the movement in the underlying asset. We'll go into more depth in a second. Leverage, gearing, or margin is ultimately how much you're borrowing to take the position on. Now, a CFD, the benefit of a CFD is that you do not have to put up the full valuation of the CFD. You use what's called margin or leverage or gearing, however you want to package it. They're similar things, but they're just referencing slightly different ways of looking at something. And that basically is formed as a percentage. So if you've got £100,000 worth of position and you've got 10% margin, it means you only have to put up £1,000 to manage that position, which can be good, it can be bad. We'll look into that. And Libor is the London Interbank Offer Rate, and that's basically the commercial interest rate, and that comes into play basically when we are understanding how much it's costing us to hold this CFD.